Hi, Dr. Al Brooks. Such a pleasure and an honor to have you on the podcast today. I really appreciate you being here. It was really nice to meet you finally at the Orlando conference, and I just wanted to say that I'm extremely grateful. I think I speak for the entire Price Action community when I say that we're extremely grateful for all the work that you've done and all the knowledge that you've shared with us.
I appreciate your kind words, and I really appreciate the opportunity to be able to speak to your group. And I'm very grateful for all the help you provided at the workshop. I couldn't talk to everyone as much as I wanted, and you talked to so many people, and you did so many other things, and you answered so many questions. I think everybody was very happy that you were there.
Thank you. I appreciate that. So to get started, I kind of want to start with your origin story. How did you get introduced to trading? I know you started as an eye surgeon. So what intrigued you about day trading, and how did you make that transition over?
Well, it goes way back to when I was a kid. I grew up in a poor family, and there were six of us in a two-bedroom house with one bathroom and no shower. I didn't get my first shower until I was in high school. My mother and my father, he was born in 1904, which is crazy to think of that. And he stopped going to school when he was 8 years old. So I didn't have a lot of parental guidance as far as professional career choices go. My mother told me when I was young that she thought I should be an eye surgeon. And I never asked, why an eye surgeon? Why a doctor? Why not a lawyer? Why not a businessman? And I just never questioned it. Back then, it was in my community, you just do what your parents said. And my mother told me that she wanted me to be an eye surgeon. So I decided I was going to be an eye surgeon, which is, by the way, is no small task. It's very difficult to get into medical school. And then when you're in medical school, becoming an eye surgeon, ophthalmology, it's one of the most difficult residencies to get into. So, I did what she wanted, and it was hard to get there. But I was at the University of Chicago, and all the while I was there, I just kept thinking about the Chicago Board of Trade and the Chicago Mercantile Exchange. And my friends in the business school, I also knew some guys getting economics PhDs, and I just felt like I was just doing the wrong thing. So, I just felt like it's my life, and I know I'm making my mother happy, but it's my life, and I really got to do what I want to do. And my heart was trading. I really wanted to be a floor trader. Nobody's a floor trader anymore, but back then I really wanted to be a floor trader. If not a floor trader, then any kind of a trader. I just liked the intellectual stimulation of it. And it took a number of years for me to get the courage and the confidence to make the switch. I made a lot of money as an eye surgeon. I had a surgical center. I was a young guy. I was in my 30s. And I started trading at home before I went to work. And it was frustrating. When you become a doctor, the way you become a doctor is you watch somebody who's already good at it, and you learn what they're doing, or you read books and you learn that way. And I assumed, and that's what I did all the way up to becoming a doctor. That's how I became a doctor. So it was an approach to life that was very effective. When I started trading, I tried to apply that same approach, and it was failing. And what I soon discovered is those who know don't talk, and those who talk don't know. And back in the 80s, it was incredible how dishonest so many people were on websites and selling software. Back then, it wasn't websites; it was magazines, and and I just couldn't believe that people could be that dishonest. So I trusted them, and it took years for me to realize that the people who were publishing stuff, books and magazine articles, conferences and tutors, it was all garbage. It was all lies. And it took me a long time to have the confidence to ignore these people who were supposed to be experts and just go off on my own. Anybody who looks at a chart, you look at this chart, you say, oh, it's down here, and later in the day, it's up here. This is a 5-minute chart of the E-mini. And you say, well, if I buy them, I'm going to make money, right? And you can just look at that, and that's what you have to do. And it just took a long time for me to look at a chart and trust that what I'm seeing makes sense, and that I should do what I believe is I should be doing. I when I was following all these people, and I hired tutors, I went to conferences, and I took all kinds of courses, and I was not making money. When I was talking to the people, the experts, I realized that a lot of what they said was not consistent with what I was seeing on the charts. So I decided to, instead of relying on them to tell me what to do, I would just look at a chart and figure out what to do. As I said, when you look at this, the only thing to do is buy or do nothing. Especially once you have this, you have to buy. And so you don't need indicators to tell you that. You don't need an expert to tell you that. You can just see it's going up and it's accelerating up, and you just have to buy. And you have to look at a lot of charts to have confidence in your ability to predict. Every day, back in the 80s when I started, I used to print out charts every day. And I used to draw lines, trend lines, and support and resistance lines, and measure moves. And I'd look at bars, I'd look to see how big the tails, the wicks are on top and on the bottom. I'd look at bear bars, bull bars, and I try to get some sense of repeating patterns. And I knew there had to be repeating patterns because I knew some people were consistently making money. And to make money consistently, you have to be repeating behavior. And if you're repeating your behavior and making money, that means what you're seeing on the charts is repetitive behavior. And that means patterns. So you have to get a sense of what patterns are, and what is going to follow. So when you see this, what will the bars to the right look like? And over time, as you know, I have an encyclopedia of patterns, and basically about 100 basic patterns, and then there's a bull version and a bear version, so that's 200 patterns, and then there's a failed version and a successful version. For example, you have a head and shoulders top here, left shoulder, head, right shoulder. Instead of the market going down, it went up, right? So it's a failed head and shoulders top. And on television, you always hear experts talking about, oh, it's a head and shoulders top. And when I hear that, I think, well, if it's a good looking one, there's a 40% chance the market will go down. There's a 60% chance it won't go down. 60% chance it'll either keep going sideways or it'll go up. So just because there's the head and shoulders top does not mean that it's a short. You have to understand more about head and shoulders tops, and you have to realize that only 40% of the best looking ones will actually lead to a trend reversal. 60% will not. One of the interesting things is how simple it is. Right now, you and I are talking on our computers, and it's being sent up through the internet. And everything that we're doing is basically either a positive charge or a negative charge. Every piece of software is based upon a strings of zeros and ones, zeros and ones, zeros and ones. And it's really, so the building blocks are really simple. You hear binary stuff, you hear hexadecimal stuff, and you hear of megabits and megabytes and kilobytes and all that stuff. It's all just basically based upon positive or negative, just a string of them. And a chart, it's the same thing. Either a bar is bullish or it's bearish, and you have to have a sense of is it bullish or bearish? Is the market going to go up? Is it going to go down? There's actually a third thing. It could be fairly neutral. Maybe the market will go sideways. And so the patterns are all based upon really simple stuff. I'm always looking for double tops, double bottoms. I'm always looking for wedge tops, wedge bottoms. I'm always looking for strong breakouts, like this. I'm always looking for the market going sideways. When the market's like this, I'm much more inclined to trade with limit orders, selling at a high, selling more higher, and taking quick profits, or buying at a prior low and being willing to buy more lower and then taking quick profits. So
Right. Yeah.
Sorry, a long answer.
Yeah. No, that makes sense. And I actually wanted to ask something about what you said. When you started to notice stuff on the chart, how did you know that it was meaningful? Like, were you doing a lot of categorizing and comparing charts? Because something can happen on a day and it might be a low probability event. The only way to know that is to have enough data to know that it happens often or it's a low probability event. So in a situation where you notice something on a chart, how do you go from noticing it to then building probabilities around it?
It's really hard. It takes a long, long time to develop confidence in what you're doing. In your list of questions, you talked about that 40 to 60% probability, that we live in a 40 to 60% probability world. And by that, what I mean is at any moment, there's a 40% chance the market will go up, a quarter of a percent. Between a 40 and 60% that it will go up a quarter of a percent before it goes down a quarter of a percent. That it'll go up 5 points before it goes down 5, before it'll go up 10 before it goes down 10.
Right.
So, there's 40 to 60% of the time, and 40 to 60% of the chance, buying or selling, that's your probability of making money. You're not going to be more certain than 60%, and you don't have more than a 40% chance of being wrong. 95% of the bars on the chart. 5% of the bars on the chart are this, and the probability is 70% or more the market's going to do something. It's going to go up. So so you got 81 bars here, and you got 4 or 5 of them, about 5% of the bars, there's a really high probability that the market's going to go up 5 points or 10 points before it goes down 5 points or 10 points.
Right.
So this is what I love, but most of the bars on any chart are that, or like a channel where the probabilities are 40 to 60%. And the more charts you look at and the more patterns you train yourself to see, the more confidence you'll have in relying on those patterns going forward. I've looked at the 5-minute chart pretty much every day since 1987. And if you do the math, I've told you this before, that is, over 500,000 bars, 5 minutes at a time. We've been talking for what, 10 or 15 minutes. So I'll multiply that by several 100,000, and that's how many bars, how long I've looked at bars. And, you don't have to be a genius to see patterns, right? You just see them all day long. Here, you look at this low and that low, about the same price, and there's a big tail at the bottom. The market went up quickly after testing that low. That's a double bottom. And here you got 3 pushes up. The market 3 times tried to do something. That's a wedge. And you get a bear bar. It's probably going to go down for a couple legs. 1, pull back 2. Here you get another double bottom. Here you get a breakout above that high. You're probably going to get a second leg sideways to up here. Here you get a bigger breakout. And this low right here stayed above these highs. So therefore, there's a gap between that low and these highs. Maybe it'll lead to a measured move up, and it did. And then you have another breakout here, and this low held above that high. So maybe this rally will go up for a measured move based on maybe the start of this move from here to here, maybe all the way down from here to here. Measured moves, I'll show you something interesting. I don't know if I can. Okay, this is a daily chart of the E-mini, and you see this high, and then this low. There's a bull flag. Instead of leading to a new leg up, it failed, and we broke to the downside. So you have to wonder, it's going the wrong way. So maybe it'll lead to some kind of a measured move. So if I connect that high to this low, you can call this a double top with this high. You can call it a lower high double top with that high. In any case, it was a bull flag. Instead of going up, we broke to the downside. So maybe we'll go down for a measured move. Measured move from that high to this low is right there. Okay, today's low. I'm going to put up a 5-minute chart here and look at the pink line on the 5-minute chart. Right there. Look at today's low. To the tick, it's exactly at the measured move, right? So that is a type of pattern that I'm looking for. I was looking for that measured move, and very often it's exactly, Carter Worth on Fast Money always says to the tick. and he doesn't mean it. He means approximately. This is to the tick. That low is exactly at that line. And the computers bought, and they bought all day. And here they accelerated up. Another pattern. The market was in a very tight range all day, and the range was only about 25 points, about half the size of an average day's range. So what are you thinking? You're thinking, the range is probably going to double and get up to an average day's range. So whenever I see a really quiet trading range day, I'm always looking at the middle of the day, sometimes later in the day, for a breakout in either direction, and then an attempt at some kind of a measured move. So I was ready for this, and that's because I've looked at a lot of charts, and that's a pattern that you see. So if you have a small range for several hours, and it's about half of an average day's range, there's probably a 60% chance you're going to get a breakout and a measured move based upon the range, doubling the range and make it back to the average. And we ended up having bigger than an average range. We went outside up. Yesterday's low went below it. Yesterday's high went above it. Right now I pretty much know, what's going on all day long, and I know what the probabilities are. Is the market likely to go up? Is it likely to go down? Is it basically a 50-50 market, a 40-60 market, and be ready for anything? Once you've done it a lot, you just know. And I know the stuff to look for. And when I talk about living in a 40-60 world, a lot of what I see is a lot higher than 40-60, right? Higher probability than 60. And but I don't say that, because for most people, you're better off just thinking 40-60.
Right.
And because that's true for most people. And there's something magical about 40-60 mathematically. And you know it. I talk about trader's equation.
Right.
Anytime you take a trade, you're in some kind of a gray fog. You're never certain. You're never as confident as you want to be. You want to be 70, 80, 90%. Well, you're not going to be. It's more like 50-50, 40-60, something like that. But if you figure out where your stop has to be when you take that trade, and you go for a profit that is twice as big as your risk, you're going to make money. Because if it's 40-60, even if you're wrong 60% of the time and right 40% of the time, if you go for a reward that's twice your risk, the worst you're going to do is break even. And if you manage your trade well, and there are a bunch of other factors, I talk about them in the course as well, you can actually make the math better than that. A lot of times it's 45% or 50% and not 40%. A lot of times the reward will be greater. A lot of times you can add on. So that 40-60 is really helpful in terms of structuring trades, because as long as you go for a reward that is at least twice your risk, mathematically you're good. I'll tell you another thing. 90% of days have at least one swing trade with a good signal bar, either a sell signal bar or a buy signal bar, that leads to a profit of 40% of an average day's range. And the average day lately has been about 50 points. Today it's a little bit more than 60, right? So 50 points, 40% of 50 points is 20 points. That means 90% of days will have a 20-point swing trade that begins with a good buy or sell signal bar. Okay?
Yeah.
And today we didn't have that. These are not good buy signal bars. That's not a great sell signal bar. And if you took it, you certainly would get out either here or a second reversal up. This is a good buy signal bar. We're getting near the middle of the day. We know the day's range is going to double, right? So you either buy that or you wait and you buy that. This is a triangle. We have a lower high, and then we have three lows that are essentially the same price. So that's a triangle, and we broke out. We tried to make a failed breakout. We tried again, and we formed another triangle. So that's another buy. So this is a good candidate. If you exited below that, you could buy again here, and you would have made your 20-point swing. So if you patiently just look for a 20-point swing every day and look for a good signal bar, I think it's a really good strategy. So that's just one of those things that you see, when you look at a lot of charts.
Yeah, that makes sense. And to your point about sometimes it's more than 60%, I guess that also means that it's sometimes less than 40. So as long as a
Right.
trader avoids those times, like they
If
don't
you're
take
shorting, once you see this break, you know there's going to be a breakout. In
yeah,
this case, it's a very big bull breakout. And say, wow, look at that bar. That's very different from all these other bars. Something
right,
has changed. This bar has changed, right? So when you see that, you got to think, I got to buy. And even if you bought the close and get out below this bear bar, if the market is in a trending mode or possibly a trending mode, and you exit, in this case, a bull trend, as soon as you see a bull bar closing near its high or above its midpoint, you buy again. So you buy above that bar, you buy above that bar, you buy above that bar, you buy above this bar, you buy above that bar. Bull bar closing near its high, you buy above that. Bull bar closing near its high, buy above that. If you get out below this bear bar, you buy again, you buy again, you buy again. So,
right. So
and
when
those
it
are all high probability.
yeah, and so when it comes to, because that seems really clear, and you talk about the Forrest Gump trade, but so that seems very clear. But then how I noticed for myself, when there's a 40 to 60% chance, and you're always convincing yourself of, like, if you're a bull and you want to buy, but you're convincing yourself of the bear case so that you know that there's a range, never be too certain. How does a trader develop the conviction to take the trade and to trust it? Does that come with just seeing it over and over again? Because I feel like it leads to analysis sometimes, and you just can't do anything because you see both sides.
It takes a long time to trust yourself, right? In anything, it just takes anything that's important or serious or life-threatening, anything. It just takes a long, rock climbing up Half Dome in Yosemite. It takes a long time to develop the confidence that you can do something. And you just have to look at a lot of charts and recognize patterns. And then I talk about the Forrest Gump trade or the Walmart trade. You see this, you see the setup, you put the trade on, and if you find yourself getting out either with a small profit or a small loss, the next time you take a trade like that, put a stop in. You see how many points you have to risk. Maybe you have to risk 8 points for that stop. So 2 times 8 is 16. Put a limit order to exit at 16 points and have it order, cancel, order. If one gets filled, the other gets canceled, and go to Walmart and come back in an hour or two. And 60% of the time, or 60, well, let me change that. At least 40% of the time, you're going to have your limit order, your profit order filled, and your stop order not filled.
Right.
And the times that you come back from Walmart and your limit order has not been filled, a lot of those times your stop order will not have been hit either. The market will do something like this.
Right.
So you're not necessarily losing the full 8 points 40% of the time.
Right. So this is something where the trust comes through trial and error. It comes through making mistakes. And over time, you see that, if I had gone to Walmart, actually gone to Walmart for 2 hours, I would have made money. And you just constantly see that you're making the same mistakes and that your initial instinct or your initial analysis was correct. And I guess it's just building that trust in yourself that comes over time when you just constantly see it over and over again.
One of the difficult things when people are starting out is they make a mistake. They make it again. They make it on another day. And then they say, aha, okay. Every time I do that, I lose money. And then they keep doing it. Even though they know they're not supposed to do it, they'll keep doing it. And, it's just a psychological thing. Maybe this time it'll be different. And no, it's not going to be different. It's going to be the same. You're going to lose money again. Stop doing that. If the market is doing this, don't sell, only buy. All right. If you see sell signals, don't think of them as sell signals. Think of them as exits from longs. Don't think of them as the start of something to go short. And then just wait for a bull bar closing near its high like this, and you buy again. So if you exit below that bear bar, you buy again. Exit below that bear bar, you buy again. So, and if it looks like the bears are having a very difficult time making money, don't sell. Right? Okay. You get this breakout. Did the bears make money below this? No. So do you really want to sell below that? No. And did the bears who sold below that make money? No. So do you really want to sell below this? No, right? And, here, you want to sell below that? It's a wedge. Well, have the bears been making money? No. So do you want to do something bearish? No. If you're long, you get out, but you buy again if you see a bull bar closing near its high.
Yeah, and that kind of goes along with what you often mention in the room, which is don't be the first person. Don't expect it to happen for the first time. If bears haven't made money yet, don't try to be the first bear to make money. Just wait till they're making money consistently, and then start trying to make money with stops.
Yeah, and in this case, the bulls. If you're not doing any trading here, that's fine, right? But then you see, wow, the bulls were able to make money here, and they made money here. So you don't have to take the first buy here or here. Once you see the bulls making money with stop orders, they can make not just 5 points, they can make 10 or 15 points. You're saying, wow, that's really good for the bulls. I want to be a bull.
Right.
So once you see the bulls clearly making money and making a lot of money, only look to buy. So, and what does Al say and how to buy? If you don't know anything, wait for a bull bar closing near its high and enter on a stop 1 tick above the high of the bar. And you can put your stop below the low of the bar. So you buy above this bar, put a stop below. You buy above this bar, put a stop below. You buy above that bar, stop below. If you get stopped out here, you can buy again.
And Al,
I'm sorry, go ahead.
No, I was going to say, can you briefly talk about, because we're talking about this chart now, can you briefly talk about how a swing trader and a scalper would manage these differently? So for example, the breakout on bar 50, the surprise breakout, when they see 51, are they going to look to exit at the 50 close? Or are they going to, is a scalper going to exit at the 50 close, or is a scalper going to stay long? Or is a scalper going to exit below 51 and then buy again above 52? What would a scalper be doing here, and what would a swing trader be doing?
Okay, 50 is a really special bar, right? Sometimes you get these really, really big bars that close somewhere in the middle. And your first reaction is, oh my gosh, that's terrible. But on a smaller time frame, that big tail might be a bull flag.
Right.
And it was here. I didn't check a 1 minute chart. I can't get it here. I'll try it here.
I can show it.
Let me just try a 1 minute chart. Okay. Let me go back over there.
Yeah.
Right?
Yeah, it's very clear.
The bar, does it look all that bearish here? No, it looks like a wedge bull flag, 3 legs down, 1, 2, and 3.
Right.
Right. So sometimes you get the big tail on the 5 minute chart, and it's a bull flag on a lower time frame chart. So if you remember on a bar like that, if you're experienced, you can just buy the market and put a stop below the most recent low down here.
Right.
And you say, well, I don't want to risk that much. Yeah, well, if you don't want to risk that much, then just trade small.
Right.
And trade small, 20% of your normal position. If you trade 5 micro E-minis, 20% is 1 micro E-mini. If you trade 1 E-mini, 20% is 2 micro E-minis, right? And you can add on afterwards. So, but whenever I see a big bar like that with a big tail on top, and it's a really special bar, the odds are really high it's going to go up. It could have been a trap, right? But I knew the range was going to double, and that's a really special bar. So I would not I would not short the first reversal down. I'd wait to see if we get 2 or 3 bear bars. Hey, I bought during 50. I'm going to scalp out. 5 points is probably a scalp today because of how tight all the range is. Right. So you buy above 49, you scalp out 5 points. If you buy during 50, you scalp out 5 points. And you might sell below 51 if you're a scalper, hoping it's a failed breakout. I would not, because that it's really an exceptionally big bar. And
if you're long on the 50 close and then you see 51 and you're a scalper, what would you do?
Either get out below 51, the bear bar, but I would not short, right, or hold with a stop down here and hope for the best. Right. Yeah. And I know the math of this. I know it's like 70% that we're going up, even with that bear bar. And if you did get out, you buy again above 52, you buy again above 53, buy again above 54, above 58. And as soon as you get in, you put a stop below the most recent low, 52, or the size of a scalp below. Let's say you bought 54, you can get out the size of a scalp below 54, or below a bear bar, 56. A swing trader could put a stop below the most recent low. But let's say he bought let's say he bought him at 49 and the market's up here and he's still long, right? So now he has 25 points profit, and he's 25 points risk, right? That's too much to risk. So he'll take some partial profits. And a lot of traders did that, and that created these two bear bars, all right? And you wait for a bull bar closing near its high like that, and then go back to your full size position.
Right. So a scalper is more quick to exit, but they have to be quick to get back in when they see a bull bar closing on its high. Whereas a swing trader can use a stop below the prior low, but they're going to want to take part off when the risk gets too big and then add it back on above a bull bar or when another setup presents itself. Is that accurate?
That's accurate. And a swing trader often has to risk more than a scalper. So, for example, if you're taking trades on the daily chart and the average bar is 50 points tall, you're going to be risking at least 50 points.
Right.
Right. You're not going to trade the same size as you would on a scalp where you might risk 6 or 7 points. Right. So the bigger your time frame, the longer you're planning to hold on to the bars, the smaller you have to trade. And if you trade and you get in early on where your risk is small, and then the market goes your way, if you bought above 49 and put a stop below 48, your risk is small. But then the market does this, you have to take profits because now your risk is from here, the current price, down to here. And you can say, well, it's other people's money. No, it's not other people's money. Look at your account. It's in your account. It's your money. And, you cannot risk that much. So you have to take profits. And that's why you get this. The computers are taking profits and they wait to see if other computers start to buy. And if they do and form a bull bar closing near its high, the people who exited here go back to their full size position there.
Right. So a scalper is constantly exiting and getting back in. A swing trader is holding and lessening their position size based on the profits that they have in their account. What would you have to see if you were a swing trader and you got long above 49 or doing 50? What would you have to see to exit based on the premise changing?
Depends. Some swing traders will be very quick to get out, and those are swing traders who are quick to get back in. Right. If you find that you get out below 51 and you do not buy again above 52 or 53, right, you got to change what you're doing. Right. And that's one of the big problems with scalpers and trends. They take the first scalp and then they never get back in. Right. And that's why traders should focus on swing trading because they'll miss too many trades. And how do you get back in? You can see where to get out. If you're long, you get out below 50, you get up below a bear bar closing below its midpoint, below 51, below 56 or 57, below 61, right? And where do you get long again? I've said several times already today. If the market is, if it's not a good short, then it's probably still long, and you have to just wait for a bull bar closing near its high and place an order to buy one tick above the high of the bar, and just do it and hold on. And if you find yourself doing it and exiting with 1 or 2 points profit, go to Walmart, go out and take a walk for 10 minutes, do something to stop yourself from doing that. Right? If you're a swing trader, you cannot be scalping. If you're a swing trader, then swing trade. And once the market has gone a while, let's say you bought up at 52 and the market's up here, you may tighten your stop. Maybe you'll put it the size of a scalp. Let me just talk a little bit about that. I said you can get out below a bear bar closing below its midpoint and then buy again above the next bull bar closing near its high, right? Or you can also get out below a bull bar. If the market goes far below a bull bar, you cannot hold forever because sometimes it'll go below a bull bar and go really far below that bull bar. If you're short, you can get out above a bull bar closing above its midpoint, above 23, or you can get out the size of a scalp above 22. So if 23 was a big bull bar closing up here, 10 points above 22, you don't want to get out up here. You'd get out the size of a scalp above 22. And why the size of a scalp? Because if it went up the size of a scalp, then a bull buying with a stop above that bear bar made money. And you want to be holding short at the low in a market where bulls are making money with stops? Okay.
Right.
No. Okay. So you're willing to buy at the high of all these bull bars at the high of the day, as long as the market continues strong like that. And if you see bears making money with stop orders, okay, then the market is not as strong as you thought, and you cannot be holding long from the high, right? But if you see bears not even making money with limit orders, then it's really good to get long. So let's say a bear sold with a limit order at the high of the day, betting this breakout would fail, right? And so he sold more 5 points, 10 points higher over here. He places a limit order to get out break even at his first sell at this price, hoping to get out break even on his first sell, and with a profit on the second and third sell. And the market came down. But look at the 52 low. Did it go one tick below the breakout point, the 19 high? It did not. So those bears who sold at that high with a limit order and sold more higher got screwed. Okay, so limit order bears were losing money. Same thing here. Let's say a bear sold at this high, they get filled here, sold more 5 points higher, 10 points higher, and they place a limit order to get out break even here and with a profit on their higher buys. And then you get this bar, 60, was it 1558? Okay, it gets near the price they needed, but did not get one tick below it. It had to get one tick below it for them to get filled. All right. So limit order bears are not making money. All right. It's easier to make money with limit orders than stop orders. Right. You can, even in trends, you can bet against a trend with limit orders. Right. But if you're selling in a bull trend with stop orders and you're making money, the bull trend has probably become a much weaker bull trend, like a bull channel, or it has probably become a trading range, or possibly even a bear trend. So if you're a bull and you've been buying at the market or at the high, and now you see stop order bears making money, you cannot be buying at the high anymore. You have to switch and buy pullbacks.
Right.
That's why I'm saying that you get out the size of a stop order scalp below any bar, including below a bull bar, because if the bears are making money with stop orders, then the bull trend is not the bull trend that it was. It's no longer a really strong bull trend, and therefore you cannot be long at the high of the day.
Right, that makes sense. Okay, I want to come back to the charts, but I wanted to ask you a question about your journey. And you mentioned that it took you 10 years to become consistently profitable.
Mm-hmm.
Was there ever a time when you felt like you weren't going to be able to do it, and that you felt like you were going to fail? And if you did feel that, how did you get through those times?
I always believed that I would succeed, because I knew that somebody was making money consistently. I never worked for Goldman Sachs. I never worked for Morgan Stanley. I never worked for BlackRock. And so I have no personal knowledge of that, but I just strongly believe that somebody out there is consistently making money. You can look at the stock price of Goldman Sachs; they're making money, but that's not necessarily from trading. They do IPOs, they do public offerings, so they do a bunch of other stuff. But I just honestly believed that someone was understanding how to make money by looking at charts. And that was just an unshakable belief. I'd look at charts and I'd see a chart doing that or the opposite going down, and there must be some way to make money out of that. So I just totally knew that somebody can do it. And if somebody can do it, why can't I? It's not like they have some secret thing going on that Goldman Sachs is secretly buying. Well, if Goldman Sachs is buying, it's not a secret. This is what happens when they buy. Okay, so if Goldman Sachs, Morgan Stanley, and all the other hedge funds buy, this is what happens. I can see it on the chart. So they're not doing anything secret. It's there, and I can see what they're doing. I want to do the same thing. So I want to buy, and I'll make money just like they're making money. So I always felt that I could figure it out. And it's an eat what you kill business, right? I still have to be out there, killing stuff every day, right? So it's not like, you at some point you get on easy street and like a savings account and you get interest every day. That's not the way it is. Every day you have to be out there working and trying to be good. And you never have to be perfect, and you never have to be great, and you never have to be a lot smarter than everybody else. You just have to be consistently good. Some of the best surgeons were not necessarily the smartest guys, but they're just really consistently good. So you just look at their skills and their basic judgment. They're wise. They're not necessarily high IQ, but they're able to stay objective, and they're able to consistently do what they need to do. You look at the chart. On a chart like this, I probably see 50 reasonable scalp trades with stops or limit orders, and I've never once traded a day perfectly. Sometimes I've traded perfectly for a couple hours, right? But stuff happens. I have to go to the bathroom. I got to eat. I get distracted. I got to do a podcast with Faisal. This stuff happens, and plus it's just hard to be that connected to the market for 6 hours and 45 minutes. So 81 bars. So, but a lot of times I trade perfectly for spurts, but I've never once traded 81 bars perfectly.
And you're saying you don't need to?
Yeah, you don't need to. You don't need to be perfect. You just need to be good and consistent and unemotional, objective, and comfortable with the math. But it takes a long time to get comfortable with the math. It takes a long time getting used to the idea that losing regularly is part of the job. Most days I will not win on 90% of my trades. Some days I'll go several days in a row scalping, and I'll win on every trade, 100% of the trades. But I don't worry about winning 100% of the time or 90% of the time. I know if I just do what I know how to do, I'll win often enough so that I'll end up with money.
And so other than that unshakable trust that you could do it, what do you think there's a personality trait that you feel is most responsible for you becoming as successful as you become?
Yeah, I think maybe the single, you always hear about discipline, but I think something more important is just honesty. Just be honest with yourself. Look at what you're seeing, and be honest. Don't say that it's going down when it's going up, right? It's going up. Just be honest. It's not going down. It's going up. It's going up, right? And don't say, oh, maybe this time it'll be different. No, it's going up, right? So just just be honest. Just look at it. You don't come up with these crazy theories that somehow it's not going up. It's going up. So.
Yeah, and there's something you said in the room a few years ago that really stuck with me. It's incredible life advice, but for trading specifically, you mentioned that when you make a mistake or you mess up at something, there are so many people out there who want to put you down. They're gonna make you feel like you deserved it. Some people want you to fail. And you said, I'm never going to join that party. I'm never going to be one of the people who puts myself down. And
that's right.
And because if you think about it, you need capital preservation, but if it's going to take 7 or 10 years, you need self-preservation. You need to make sure that your emotional state stays preserved. And that thing you said to me, or the thing you said in the room, really stuck with me, because I realized that you have to be an advocate for yourself.
Totally, absolutely. You have to never be hard on yourself. That's everybody else's job. So many people in the world enjoy, seeing other people suffer, right? So you just have to just accept your shortcomings, accept that sometimes you're going to screw up. You're often going to screw up, and don't be hard on yourself. Just say, yeah, I screwed up, but I'm trying hard, and tomorrow I'll try to be better, or try not to make the same mistakes, and and just trust that you'll be able to to do it well enough to consistently make money. I want to say one other thing. You're talking about scalping and swing trading. I want to show a slide here. I talk about this slide every now and then. Let me see if I can find it. It's probably one of these. Yeah. Okay. This is the Dow Jones Industrial Average going back 100 years. Okay. And the point of this slide is, you're asking about scalping and swing trading. Anybody can make money trading, and you don't have to be a genius, right? You just buy and hold. So if you're 25 years old and you have $1,000 in your IRA, just buy and hold. What do you buy? Buy an ETF that buy spiders, or buy some any of the ETFs that follow indices. And even if you bought at the high of the 1929 crash and you're 25 years old and you held through the market dropping 89%, 20 years later you made money, and 30 or 40 years later you doubled your money. This is a log chart. And so you don't have to be a genius to trade, especially if you're young and with your retirement accounts. You just buy and hold, just keep adding and never exit. And look at this. We've had 56% corrections, 49, 48, 60% corrections. And we had a 34% correction during the pandemic. You're going to have them, but just in your retirement accounts, that you just take an index fund and just hold it forever, and you'll make money. So what about day trading? Well, if you can make money on a yearly chart, the better the smaller time frame chart that you have, the more. Well, let me do this. Go back over here. All right, on a 5-minute chart, if you add up all these legs, it comes out to a lot more than the range of a day. And if you add up all of these legs on a 5-minute chart over the course of a year, it comes out to vastly greater than the total points from the low of the year to the high of the year, right? So the shorter the time frame, the more profit potential you have. And for everyone, there's a sweet spot. Some people can only trade the yearly chart. They just buy and hold and exit 30 years later. And those people are absolutely going to make money. And other people can, buy and hold and get out in 3 years. Other people can buy and hold, or sell and hold short in 3 days, or or a week or two, right? And the better you are, the shorter the time frame that you can trade, the more money you're going to make. If you're trading well, the shorter the time frame, the more money you're going to make. And everybody has a sweet spot. For me, I like the 5-minute chart. I feel very comfortable with the 5-minute chart. But if I put up a 15-second chart, I'm probably not going to make money. Plus I'm not going to have fun. So there's a balance. I always talk about how you're trading to make money, but you have to be in your comfort zone. You have to be happy. The goal of life is happy. Having money makes you happy, right? But earning money, you have to. If you're going to be doing this a long time, you have to be happy with what you're doing. So not only do you have to find a way to make money, you have to find a way to make money that you enjoy doing. So, and for some people, it's 5-minute chart. Some people might be a 60-minute chart. Some people might be a daily or weekly chart. It doesn't matter. If you get good at it, you're going to make money. You'll make more if you're really good at trading a 1-minute chart and taking 100 trades a day. But nobody's going to do that.
Right.
Computers might do it, but people are not going to do that.
Right. So there's a sweet spot where if you can capture the meat of the legs, then instead of just holding all the way through, if you can capture it on the way up and then buy lower and capture it on the way up and buy lower, if you can split it into the legs and capture most of that, you'll make more than a swing trader, but you have to find the sweet spot for yourself.
Right. If you look at any chart on any given day, there are usually 10 to 20 reasonable stop entry scalps and at least 20 or 30 limit order scalps. So, so the trades are there, but you got to take them and you got to manage them correctly, and you can't screw up. So it sounds simple, but it's not. So most people should wait for the best setups, the ones that are most likely going to lead to a swing, and manage those correctly.
Right. Now, speaking of that, I think that's a really important topic that I wanted to touch on. So I see different forms of technical analysis as like different languages telling the same story or telling the story of the market. And there are some simple languages that explain it very briefly and just give you an overall picture. Like they might say, the price is above the moving average, it's in a bull trend. And there are other languages that are much more complex, like BPA, and they tell a much more compelling story. So they might say, BPA might explain the chart as a small pullback bull trend above the moving average and two open gaps and a measuring gap above bar 17. And then even if it gets to the measured move target, we should still get 3 lows below the moving average, 1 close below the moving average, because we haven't touched the moving average all day. So the information present is the same, but the language that tells a story can determine how much information you get from it. And so the obvious benefit of BPA as a storytelling method is that it gives you so much more accurate information. But by the same token, it's also so much more difficult to learn because there's so much complexity. You pretty much talk about the theory and the probabilities of everything. And so parabolic wedge, to fade breakouts in trading ranges, breakouts plus follow through, bull flags, bear flags. But then once you have all that information, how do you turn it into a workable system for yourself?
Most traders, they should patiently wait for what appears to be a reasonable swing setup. For example, a double bottom, a wedge bottom, double top, a wedge top, or for a strong breakout, especially a strong breakout with follow through, and then trade with a swing. And usually the best swing trades are going to have good signal bars. So you wait for a pattern and you wait for a good signal bar. And if it's a buy, you buy above the good signal bar, put a stop below the most recent low. So if you buy above 49, put a stop below 48. If you buy above 35, you put a stop below 34. And then you swing trade. You just hold on until it no longer looks, it's no longer doing what you want it to do. And then you exit.
And do you think traders should focus on all available swing setups, or should they just focus on, like one trader would say, I'm going to focus on bull flags and bear flags only? Would you recommend that? Or would you recommend that you take every reasonable swing setup that you see?
I don't think it matters. It's personal preference. You got to find your comfort zone. Some traders like breakouts, some traders like major reversals, some traders like pullbacks, bull flags. Some traders take it all. So I don't think it matters. Whatever you're comfortable doing, and like I said, don't be hard on yourself. So if you're pretty good at trading bull flags but terrible at trading breakouts, don't worry about it. Just trade the bull flags. Nobody's going to take most, and most people are going to see them a bar or two late, and they'll miss them. But if the trade is really good, you can enter late. Remember, I said just trade small. Right. So if you don't buy above 49 or above 52, you can buy above 54, right? Your stop initially might be below 52, but you buy above 54 and just trade small. Once you see, I think one of the mistakes that traders make is if they don't take a trade, or if they miss a trade, and then the market starts to do what they thought it was going to do, they start saying, "Oh, I got to wait for a pullback." Well, if the trade is really good, you ain't going to get a pullback. It's just going to keep going on without you. So as soon as you tell yourself, "Oh, I got to wait for a pullback," as soon as you have that feeling, buy at the market and trade very small and use a wide stop. If you're hoping for a pullback, that means the market is really strong and everybody is looking to buy pullbacks, even really tiny pullbacks. So you're going to have to wait a lot of bars before you get a pullback that you want. Everybody else is buying, 1-point pullbacks, 2-point pullbacks, while you're waiting for a 10-point two-legged pullback. You're going to wait a long, long time, and you're missing a great trend. So once you look at something and say, boy, I wish I took that buy the market. Buy small, 20% of your position, but buy the market. Anytime you look at a chart and say, boy, I wish I was long, you gotta just buy. Right? Don't wish and don't wait for the pullback. Just buy.
That makes sense. And actually, I wanted to ask you, you often mention that you think beginners should stay away from scaling in because the mistake that they make is that they trade way too big on the first entry. And then when it's time to actually add, they get scared because they traded too big on the first one.
Right.
So my question for you was, if a trader is managing their risk appropriately and using the appropriate size, do you think scaling in is actually beneficial for beginners? Because what I noticed for myself is that when I started, I felt a lot of pressure to get that entry perfectly right. And when the market was going up, I thought, I don't want to buy here because I only have one bullet. I only have one shot at this. So I don't want to buy a position here. I'll wait for a pullback and then it doesn't come. And so I thought if I could split my one order of, let's say 5 contracts into 5 orders of 1 contract, it might actually take the stress off of me and be beneficial for me. Would you agree with that? And what would you recommend for traders who are trying to scale in?
I think most beginners, most people who trade their IRA accounts or invest in their IRA accounts are scaling in. They might put $1,000 in every month.
Right.
They're scaling in. So everybody scales in, right? You're talking about scaling in as a day trader.
Right.
And the issue is, can you trade small enough, right? And, as I always, you brought up the illustration. Yesterday was a good example where we had those really big legs up and down. So if you bought the close of 4, do you buy all the way down or do you give up, right? If you sold 22, do you sell more as it's going up? Well, it got back down there again, but it went up, 30 points before it got back down to that bad buy signal bar, 22, right? So, most traders who sold 22, sold more 5 points higher, 10 points higher, would not keep selling. They would get out and take a big hit, and they wouldn't reverse to long. Usually, if you're wrong, if you're taking any trade, whether or not you're scaling in, and the market does the opposite of what you think, and you switch positions, you're going to make back what you lost. So, for example, yesterday, let's say you bought the close of that bar. At some point, you got to decide you're wrong. Maybe below that bar, maybe below the spare bar. So, let's say you buy the close of that bar right there, and you decide you're wrong below this bar right here. And normally, if you reverse, you can make just about what you lost on your first trade. Here, you would not have made it. You would have gotten out there. You would have made back some of your loss. But in general, if you take a trade that seems reasonable and the market does the exact opposite, instead of scaling in, you should think about changing directions, and because usually you can make back just about what you lost. Here's a better example. Let's say you're selling below bear bar, sell below that, sell below that, sell below this, and you get a bull bar. Especially if you get 2 bull bars, I would get out instead of scaling into shorts, hoping that it will come back to the high of that bar. This bear bar is a bad buy signal bar, and normally if you have a bad buy signal bar and the market goes up, it'll come back to that high. But sometimes it takes a long time to get there, right? So instead of holding short and scaling in, I would get out above a bull bar closing above its midpoint, or I'd get out the size of a scalp above the high of that bear bar and get out around there. And then you can look to sell again up here, expecting it to come down there. But most beginners, they buy the market and they buy more 5 points lower, 10 points lower. Can they double their position above a bull bar closing near its high? Most beginners will say, no, I can't do that. In fact, I'm just going to get out. Right? So you got to trade really small. If you normally trade 1 E-mini, right, and you trade small, you might, let's say you bought 2 micro E-minis and 2 more and 2 more, right? So now you're long 6. and then you get a bull bar closing near its high. You're expecting it to come back up and test this area. Then you buy 6 more, a little bit more than normal size position, right? But really hard to do.
So in the appropriate contexts, if a trader is willing to trade small enough, like in a broad trading range, do you think that if they're willing to trade small enough, it is worth it to scale in like for 90% of the bars when it's okay if you buy or sell?
Yeah, let's trading range. If you're scaling in the longs at the in the bottom third, and scaling into shorts in the top third, I think that's perfectly fine. But what happens with these bad trades is the one time you lose, let's say you win 80% of the time, the one loss is usually so big that it wipes out all your losses. Let's say here, you're selling with limit orders today, you sell at limit orders at the high of the prior bar, and it comes down and you make 5 points, right? You sell at a limit order high of the bar, sell more higher, sell more higher. And then it comes down, but it doesn't, it doesn't get back to your first sell. And then it does this, you got to make decisions, are you going to get out above this bar, or are you going to say it's not bullish enough? You get out above this bar. What happens is a 5-minute bar sounds like, if I got 5 minutes, it's a lot of time. It's not a lot of time. You're not as certain as you want to be, and you'll tend to hold on to the position too long, and you'll end up losing a lot, and wiping out a lot of your past winners. So,
Right.
Stuff like this, the losses, if you don't know what you're doing, the losses are so big that, here you are, using scaling in scalps, and you won the last 5 in a row, and you're thinking, oh, I'm pretty good. All right. And then you get that, and it just wipes you out. So the low, kind of black swan type things, low probability, but huge risk, they can really wipe you out. So if you do, well, not just scaling in, any kind of trading, once you see something that tells you that you're probably wrong, you got to get out and take your loss and not add to the position and hope that eventually it'll come back far enough for you to make money.
Right. Yeah, I think that's an important point, because when you're scaling in, your first entry is so small that even if you win 4 or 5, when you take the full loss on all your contracts, it'll wipe out way more than what you made. So what you're saying is, if you're going to do that, you have to be very good at switching your bias and realizing when the premise is no longer valid, so that you don't take those massive losses.
Yeah, it's hard. Let me give you another example here. So you sell this high, you sell more 5 and 10, 15 points higher, right? And you say, oh, that's bad. It's probably not going to come back below this high. So instead of trying to get out break even on the first trade and with a profit on the other trades, you just decide, maybe I better just get out break even on the entire trade. And it did come down far enough. If you did sell that high and sold more 5 and 10 points higher, right? It did come down far enough for you to get out break even on the entire trade, right? So you'd get a loss of 5 points on your first sell, you'd get a profit of 5 points on your third sell, and you get out break even on your second sell.
Yeah.
Most people are not going to do it. It happens too fast, and it's too emotional. And it's emotional because people are trading too big. They think they're trading small, but they'll soon discover that they didn't do what they should do, and the reason they didn't do what they should do is they're trading too small. They're thinking about their money instead of analyzing what the market is doing.
Right.
I understand the argument that I want to get rich. I really want to get rich. I want to become a trader. I want to get rich. But that's not. You're jumping ahead. The first goal is I got to learn how to trade. I got to stop losing money. I have to start consistently making money. I have to start to grow my account. I have to start to increase my position size. And then you say, I'm going to get rich, right? People just think I'm a trader, I'm going to get rich. But there are these other goals that you should really focus on. And, getting rich, that'll come naturally, right? First, you got to consistently make profit and then grow your position. And you don't have to have a huge position to make a pretty good living as a trader. If you simply take that one 20-point trade a day, that's $1,000 per E-mini contract. right? And if you get 3 of those a week, that's 3,000 a week. That's $150,000 a year. And if you go up to 3 contracts, you're around $500,000 a year. You don't have to trade 100 contracts to do pretty well.
Right. And what would you say? So based on that idea that the beginner is like your expected return as a beginner is just don't lose money, like 0% return. Just don't lose. What would you say are good expectations for beginner, intermediate, and expert traders? So beginner is just trying not to lose. What is a reasonable return that an intermediate trader should expect? What's a reasonable return, like daily in terms of percentages, that an advanced trader should expect?
Well, what happens is the more successful you are, the more accounts you have. And all of a sudden you got a bunch of money here and a bunch of money there. And you're not trading all, you're not trading all your accounts. You might be trading 1 or 2 accounts. Let's say you trade 1 account, and let's say you have 15 accounts, right? And, so what's my return on that 1 account? Or what's my return on my trading portfolio, which might be 10 times bigger? All right. So, so if you have a whole bunch of accounts, you may trade maximum margin on 1 account, which is still only, tiny compared to all your accounts. So it gets really complicated. When I used to trade, I traded online with guys, I don't know, 15 years ago, a long time ago. I don't know, 20 years ago, I don't know, long time, when the internet started coming out. And instead of talking about percentage returns, we talked about points compared to a day's range. And a good, consistent trader wants to be making about a quarter of a day's range. So if the average range is 40 points, they want to be averaging 10 points a day. All right. And that's kind of like a satisfactory minimum for a really good trader. And some days they'll make a full day's range, 100%. So if the day's range is 40 points, they make 40 points on the day. And sometimes you'll get big swing days. And if you're a really good trader, you might make twice the number of points in the day's range. So if the day's average day is 40 points, some days you might get 80 points. All right. So instead of thinking about what percentage of your account,
right,
it's better to think about what percentage of the day's range. And beginners should be trying to make anything, right? 10 or 20% of the day's range. But when you're starting to become pretty good, if you're an active day trader, you're thinking about, I really want to make at least a quarter of the day's range consistently.
And then if you become, your goal for like the ultimate goal is like the full day's range, or in some cases double the day's range. And that goes to your earlier point where if you're trading the individual legs, then you can make more than the day's range because you're making money on the way up and then you're waiting for the pullback, making money on the second leg. You can actually make more than day's range.
Also, as I said, on an average day, there are probably 10 reasonable stop entry scalps. So a 5-point scalp, and 10 times 5 is 50 points. So, if you just scalp, you can do that, and you can make it in a day's range. And I said you're looking for a swing trade that's equal to 40% of an average day's range. So if you just take 1 swing trade and you're consistently good at that, that's 40% of a day's range, which is really good. And if you do it 3 out of 5 days a week, maybe you're averaging 25% of a day's range.
Right, that makes sense. From the room, you seem very matter of fact about the trades that you're in. Like you never know if you're in a trade or not, or it's just like you're very calm. Do you think that has come over time because you're just so confident about the probabilities, or have you constantly been working on that trait of yours to stay calm? Is it something that you just developed because now you just know what's happening on the chart, or were you actively working on staying calm?
No, I never. When you've been doing this for a long time, you've tried everything, and I've done psychology courses. I've talked with psychologists, like way back when it was fashionable in the 80s, and I think it's a crock of, I don't think it's helpful. And what happens is you just, if you trade small enough, I always talk about trading the I don't care size, and that size obviously gets bigger the more money you have, right? but that's the key. You have to stay objective and calm and peaceful to consistently make money. And to do that, you're going to lose, regularly. Every day you're going to lose on some trades, but it can't be big enough that you start focusing on it. Oh my gosh, I can't believe I lost 3 trades today, or 3 in a row, or something. You got to be trading small enough so that you can just keep doing the right thing, trusting the math, trusting that if you consistently do the right thing, you're going to win. In football, American football, Tom Brady was really good at comebacks. He had more comeback victories than any other team, fourth quarter comebacks. So he's losing the fourth quarter. He's out there doing anything special. He's just consistently doing what he does all game, and he's just trusting that if he's consistent at it, the math is going to work out. And if you're losing in a game and you start trying to do 80-yard passes all the time, you're going to lose. But if instead you just keep doing what you've been doing consistently, you have a much better chance of winning. And same with trading. I remember I've come across guys, not recently, who tennis, sometimes some guys are just really easy to beat. They have some great shots, but if they start to mess up, they just start hitting harder and harder and harder, hoping that they'll blast it by me. And all they start doing is hitting it into the net or hitting it out, right? You just got to stay calm and just, consistently just try to play well and not try to do something that is a much lower probability, and the same with trading. Don't try to start to take a whole bunch of low probability trades to quickly make back what you lost, because you're just going to lose. They're low probability. You're going to lose more.
So would you say that it wasn't necessarily, and correct me if I'm wrong, but it wasn't necessarily working on your psychology that helped you, but it was the probabilities that guided you and just trusting doing the right thing every day, and that's what gave you this kind of level of certainty of the probabilities and the calm demeanor? Do you feel like it's more about the numbers and the probabilities for you?
It's the math.
It's the math.
The math cures the psychology stuff.
Right. So because I always thought that about you, that in every situation it's 40 to 60%, but you have 30 plus years of certainty that that if I do this over 30 years, I'm going to make money. So even with the uncertainty of each trade, you have the certainty of edge of the long term. And so it seems like that gives you this peace for every trade that you take.
Yeah, let me say, for those 10 years when I was losing, I was incredibly miserable. I can't tell you how stressed out I was and how frustrated I was and how angry I was at myself. And, I was so confused. It was just a miserable existence, especially those first few years. And how did I get rid of it? I just, started getting comfortable. Every day, at the end of every day, I print out charts. Well, now I don't print them out. Now I just draw on them every day. Richard, who runs my course website, he said, "Al, you keep making all these charts. Why don't you cut back?" I tell him, "I'm not going to cut back. That's my practice. I do it every day. I look for all the major patterns every day. And, and I've always done that, and I'm going to keep doing it because it keeps everything fresh. For example, today, I knew the odds were very high that we were going to break out one way or the other, right? I knew that because I regularly see this, and, I look for it, and I categorize it, and I, create a chart, and I save it in a file called Trading Range Breakouts. Let me just see if I have. This is my encyclopedia of charts. So Trading Range Day, TRD.
And Al, just for the record, you've been doing this for a lot longer than the encyclopedia has been around, right? Like you've been doing this as your daily practice for many, many years.
Since the 80s. Yeah, I used to print out the charts, and I used to have folders, and I had thousands of pieces of paper. And here, a Trading Range Day with a late bull breakout. Yeah. Trading Range Day with a late bull breakout. trading range day with not so much of a breakout, but different ways to look at it, right? Trading range with a late bull breakout. So it's not like today did something that I've never seen before. I have lots of examples of it,
Right.
and I have examples of bear breakout. You know, that's why I do it. It's to keep, it's practice. So that if I see something, I quickly recognize it, and I immediately know what to do. A lot of times I'll look back at the slides in my encyclopedia to get a sense of probabilities. If the market breaks out at, with 2 hours left in the day, is that different from breaking out in the middle of the day? If it breaks out in the final 90 minutes, is it different? What happens? I say one other thing. I talked about how that bar with a big tail on it, that big breakout bar today,
Yeah.
was a really special bar.
I remember there's an FOMC bar that has that, or that big tail on top.
Yeah, a couple of those. Yeah. But that's a good memory on your part.
I was in your room for a while, so.
That's not the one. I had a big tail on the bottom. But look at this.
Yeah, that's the one. Yeah.
Big built bar, the big tail on top. This bar was a big bear bar briefly, and then it ended up closing back at the open. And you look at that bar and you say, wow, it's very different from all of this stuff. So it's a special bar.
Yeah.
So, you just know if you trade long enough, you see stuff. And, just like you're familiar with that bar, because I've shown it several times and you've probably looked at it on your own. I knew this bar was that kind of a bar. It's a heck of a lot bigger than all these other bars. I knew we were going to get a breakout, or that we probably would get a breakout. Some trading range days stay as a trading range day all day. You get about 2 of those a month that they stay very small and sideways, but most you get a breakout. And when you see a bar like that, you say, yeah, that's the kind of bar I want to see. And
Yeah.
the tail, is probably a bull flag on a smaller time frame.
Yeah, and I think that's a really good point, because if you're looking at the breakout and you see the tail, that might frighten you if you don't have 100 examples saved with the tail on top, knowing that it's not a problem. So
right.
The fact that you have all that data to be like, no, the tail's not a problem. It's probably a bull flag. I'm going to stay long. Right. I know that this is a dominant surprise. It's going to get continuation. So I think that's important, is to have that bank of data in your mind or in a folder or somewhere, so that you can refer to them and know what the probabilities are, even if there's a tail.
And even if you don't know that, it's a bull breakout, and you have to be looking to buy above a bull bar closing near its high. Right. So you just wait for a bull bar closing near its high, this bar or that bar or that bar, and you just take the buy.
Right. And you mentioned in your 10 years that it was a tough time for you, and you still believed that you'd make it, but you said it was a miserable experience.
It was unbelievable. I cannot make you or anyone understand just how unhappy and how stressed out I was.
No, I get that. I think I'm feeling something similar. But if you look back at those 10 years, what do you think you would focus on to help speed up the journey? If you could just focus on a few things, and what would you avoid? What do you think you wasted time on that you didn't, that now in retrospect you realize, that was a waste of time. I should have focused on this, and this.
I would just focus on, like I said, honesty, just being objective, looking at the chart and trusting the math and trading small, right? And what I would not focus on is desperately hoping to get rich quickly. I got to make money to pay the mortgage. I got to make money to pay the car loan or buy food. That's deadly, because you'll end up trading too big and taking too many low probability trades, hoping to win a lottery ticket, with a lottery ticket. And that's a losing strategy. How many people do you know who have made a lot of money from lottery tickets compared to those who have lost regularly? Don't, just accept where you are and try to work through the steps, stop losing money, consistently make money, grow your account, and then increase your position size.
Right. So So focus. Don't
Patience.
try to. Sorry, go ahead. Oh, sorry.
You know, be patient and don't be hard on yourself. You know,
Right.
just constantly try to be objective and do what you need to do. And if you're consistently unable to do it on this time frame, trade smaller and go to a higher time frame.
Right. Were there losses in your career that um, that took a while to get back from emotionally and psychologically? And how did you overcome those big losses?
I never really had big losses. I always traded small enough so that it was never disaster. You know, I've had strings of losses. You know, like sometimes I'd lose every day, you know, or several times a day for several days back in the 80s or early 90s. And, you know, sometimes I would take a day off. You know, I would still watch but not trade. But now, you know, that doesn't happen. You know, I never lose enough so that, you know, when I'm after the market, I think about it. I don't think about it. You know, I just move on. I never look backwards. I'm just confident that there'll be plenty of opportunities tomorrow and the next day and the next day. So whatever I lost, I'll make back.
Right. And I guess just the consistency that you've had over the last 30 plus years, I feel like that also makes you more patient because you're not rushed to take this trade today because you know that if you don't get in on this pullback, you can buy above a bull bar. And if this doesn't happen, you know you'll get a setup in 5 minutes or in 10 minutes. And just knowing
Right.
that, seeing it over and over again, you never seem rushed. So
Right.
I guess that's what adds to your patience.
Yeah. You know, and there's always another trade. One of the fears I had way back a long time ago was that the market would never, you know, that we get a series of trading range days and it was just going to stay sideways forever. And it's not going to happen. Sometimes it's sideways, sometimes it's up, sometimes it's down, and it's always going to change. The market is constantly probing in every which way, you know, not just in terms of support and resistance, but in terms of the size of bars, the size of legs. You know, it's always doing something different. Once everybody starts seeing what it's doing, there becomes fewer and fewer people to take the opposite side of the trade, so it can no longer do what it has been doing, and it's going to do something different.
Right. What are the most important differences in how a trader should trade the AM session versus the PM session?
You know, I trade them the same. I just look for the same patterns, support and resistance, same stuff. I trade them the same. You know, the open is the most important time of the day because you have the highest probability of getting a 20-point swing trade.
Right.
But because a lot of times the market will make a quick move and then just go sideways the rest of the day. So, but you know, if you get a big move late in the day, I trade it just as the same as I would if it came back here.
Right. I think one thing you mentioned in the room is that you have to be you should be a little bit more careful on the open because sometimes the bars start off really big and then they get really small later on. So
Right.
So you mentioned that not to be very careful about how much you're risking on the open because you may not have a chance to make it back, right?
Right. Trade small. Don't worry about getting rich. Just worry about doing the right thing, because you know, like you said, a lot of times on the open you get really big bars. So if you get a loss, it's a really big loss. And then later in the day, when you're making the money back, you're finding that the bars are small and you're making very little per trade. So you always have to trade small. It's, you know, whenever the bars are big and you think, oh, I can't trade. If you're confident about the pattern, just trade 20% your normal position size. And if even that is too big, then you just wait.
Right. Is there a general rule for how long a correction should last? So like a high two bull flag or a wedge bull flag and a bull trend. So for example, the bull flag today after the breakout on 50, the flag on 51 is just one bar, and then 52 is the buy above. So that bull flag didn't reach the moving average. Even buying above 68 didn't reach the moving average. So how would a trader know how long a bull flag should last, and if they're okay to buy far above the moving average, or if they should wait for a deeper, longer pullback?
The stronger the trend, the more you're going to have to buy far above the moving average.
Right.
And the more it's a channel, and the bigger the legs in the channel, the more you're going to be buying at the moving average. But in a really strong trend like this, you know, you're not, you know, look at this. It was above the moving average for 30 bars, right? So if you wait for a pullback to the moving average, you're not going to trade.
Right. So it has to be based on the context and the strength of the trend.
Right. And as I said, if ever you look at a trade and you start hoping for a pullback, buy. Just buy small. If you're hoping for a pullback, that means you believe the market is very, very strong. And just buy small and you add to it as it goes your way.
Right. Do you see any value in using level 2s in your trading?
No, zero.
Because you're that was fast. That's because you just
Actually,
know where
on
the
this chart,
bars
I could point out 50 reasonable trades on this chart. You know, buy the low of 1, buy the low of 5, buy above 3 maybe, buy above 6, sell above 9, place a limit order to buy around the 6th low, buy the reversal up. You know, almost every bar there's something to do. And is level 2 going to give me that many trades? No.
Yeah. So you already know where there'll be buyers below, where there'll be sellers above. So you just
you know, and if you can't tell, then you know there are sellers above and buyers below.
Right. Awesome. And last question is kind of just to close it off. If someone is struggling right now, they're trading I don't care size, they've gone through all the material, they're still trying to find their path to profitability, what would you say to stop doing everything you're doing and start doing this now? What would that be?
I'd go to the minimum position size, like 1 micro E-mini, and wait for a reasonable pattern, like a double bottom on the open or a wedge bottom with a really good signal bar. And then just trade that and swing trade it. Take your trade, put the stop below, go to Walmart and come back in 2 hours.
Awesome. Al, thank you so much for your time. Really, really appreciate it. I just really appreciate everything you've done in terms of sharing knowledge, and especially for coming on the podcast and sharing your thoughts.
Thanks, Faisal, for giving me the opportunity. You know, it's always fun. You know, you're always smiling. I always like to see a happy person. And I hope that your audience finds this helpful. Thank you.